Thank you, Peter, and thank you very much for the invitation. It's a pleasure to be here. I don't speak French at all, and none of us probably, I heard a British accent, but all the others, I suppose, don't have English as their native language. So if I'm speaking too quick or you don't understand what I said, just raise your hand, of course. That's not a problem at all for me. Okay, I'm going to talk to you about the problem of insuring life. The title of a book, as you see it up here, is Insuring Life, Value, Security, and Risk. But this is a book that arises out of an intellectual challenge, which I consider to be quite important in our time, which has to do with what is the role of life insurance, one of the biggest economic industries in advanced liberal economies, in securing liberalism. So why is it that we put so much money, so much effort in life insurance, which can be an incredibly boring thing, in order to secure liberalism? And I'm going to show to you that it's not so boring, actually. There's a lot of very interesting things that happen there, but we hardly ever notice, because it's one of those technologies of governance which, in a very Foucauldian fashion, governs silently and from a distance. It manages to create an economy of security that we don't notice. The moment we start noticing it, that means it's not working. There's a very famous, a very interesting comment that some historians of science, Lorraine Daston and Francisco Vidal, made some years ago on a book on science studies, where they said that the best form of governance goes unnoticed. If it needs to brandish its weapons and summon its subjects, it has failed. And that is what I see insurance as doing. When we don't feel it, it's working, and it's becoming very, very influential. When we start noticing it, that means there's something wrong about it. But anyway, I'm going to explain this through lots of cases throughout the lecture. Now, there's a thesis that I advance in the book, and I would like to pursue through the lecture as well, which is that life insurance provides a form of security that makes liberalism transcend and survive the next crisis. You know that the history of liberalism is the history of its crisis. We always hear about the next crisis of liberalism. And yet liberalism comes out of it, always revamped, stronger, with new impetus, more profitable in all kinds of ways. And this is, it's a big question. Why does liberalism not fail? Why does it always come out strong again? And part of the answer that I advance here is that instruments such as insurance become a technological agent of liberalism. And it's a bit like a bicycle, that if you start pedaling, the bicycle stands. The moment you stop pedaling, unless you support it artificially, it falls down. Well, a crisis of liberalism is going uphill. So what do? You pedal harder, right? And you create all kinds of things out of that. In this lecture, I'm going to begin by giving you some evidence as to what is the role of life insurance in the world financially, or why should we consider life insurance as an empirical space? Why should we bother looking into something as banal as life insurance when we look at elements of order, governance, and power? The second point is going to be about the problem with life insurance. There's a big problem with it. And the big problem results from the ways in which it values the life that it seeks to insure. Then I'm going to offer you some reflections on how life insurance makes liberalism transcend. That's really the beef of the lecture. And I'll leave you with some concluding thoughts. And as I understand, this is being recorded, so you'll be able to go back through the slides if you want to think this through. So let me begin then with the financial weight of life insurance in the world, or why should we bother studying life insurance as a political site? So I'm going to give you some figures here. I'm not very much into numbers or statistics, but I find them incredibly useful. And I'm drawing heavily on data produced by Swiss Re. It's the biggest reinsurance company in the world. And they produce this very easy to understand publications. It's a journal that they have called Sigma. I think they produce 4 to 6 issues a year. And they offer data and they do their own analysis. This is all public information. It's in the public domain on the internet. So if anybody wants to trace this or learn more about it, I'm very happy to give you the references. What you see here in this graph is life insurance premium volume in comparison to GDP. So the percentage of GDP that compared to with life insurance expenditure. And what I want you to see is that there is a lot of money put into this. The line on the top, the green line, is the United Kingdom, which is one of the most developed insurance markets in the world at the moment. And you can see that around 8% of the country's GDP equals to the amount of money spent on life insurance. I'm only talking about life insurance. That's a lot of money. Oh, this is good. Thank you. The case of France is on the green, on the yellow line here. It's not as strong as the French case, but it's going up. These figures finished in 2015. That's the earliest I could find, the latest I could find so far. And what we have here, the United States, is not as dramatic. It's just below 4%. But still, this is a very big amount of money that goes into it. And so on and so forth. China, which is seen to be one of the emerging markets, it's not so big, but the volume is enormous because the amount of policies that are being written is one of the fastest growing markets. So we have in advanced liberal economies something between 8% and 2% of GDP going into life insurance alone. In this other graph, which is again from Swiss Re, what we see here is that you see this dividing line. This is the total insurance market. And if you were to draw the 50% here, you see that more than 50% of of insurances in the world are sold in North America and Western Europe. When you start adding the advanced economies outside Western Europe and the United States, you realize that around 80% of all insurance gets sold in OECD countries. So we're talking about, let's say, the economic elite of the world that is heavily insured, but that is not the majority of the population in the planet. We know that quite well. So this is a phenomenon that is heavily concentrated in liberal economies, and it's expanding. The insurance industry is trying to move on to capture new markets year on year. This other graph that I show you here discriminates between the yellow is non-life insurance premiums, and the blue one is life insurance premiums. You see the case of Hong Kong is quite dramatic. I mean, the people in Hong Kong are quite obsessed with life insurance. Why? Why is it that it's so important for them to have that? But you take Switzerland as well, and you have more than 50% of insurance, which is life. The case of Denmark is quite dramatic as well. Finland. The Netherlands is not so much. The Netherlands has some life insurance, but not as much as other places. You take the case of the United Kingdom, it's quite important. France, where are you? Way down. Way down. Whoa. I cannot see it. Well, here's Germany, not so dramatic. And yeah, France is quite interesting because it has a lot of life insurance. Now, the dot you see here is what insurance call insurance penetration. Insurance penetration is an indicator that they developed. It indicates the relative size and importance of insurance in the domestic economy. It's a relationship between direct gross premiums to GDP. So the further the dot goes on to the right in your graph, the deeper the penetration is. The dramatic case there is the United Kingdom. Well, this is just to show that we're talking about quite an important economic sector. It's very important for all kinds of ways, some of which I'm going to mention in a moment. But in all kinds of other ways that we haven't even thought about, it has implications. The last graph I'm going to show you here, and I'm going to stop with the numbers, I don't like them very much, has to do with the life real premium growth in 2016. Let's say this is the latest data that I saw Swiss Re released. And basically focus on the dark green, and these are the markets that are growing the quickest, that are emerging and developing. The red ones are not developing so much. You take Argentina here, You take Peru, it's not growing so much. Curiously enough, Australia, Oceania, I don't know why, Portugal here. But the green and the yellows are the fastest growing markets. And as I mentioned with the bicycle, insurance never stops. Insurance is an industry that keeps on pedaling and pedaling and pedaling. And in the books that Peter kindly mentioned at the beginning, the trilogy, one of the things I have done is that I go back into the history of insurance all the way to the 13th century and all the way to 2016, 2014. And I look at how insurance has evolved over this period, which is a very exciting period for the West. It's the medieval renaissance of the 13th century all the way to our time. And what I notice is that what insurers have been incredibly good at doing all the time is reinventing themselves. They create new products, they create new strategies. Especially, they create new ways of defining what is it that they are insuring. What is the object of insurance? But of course, and now I'm moving to the second part of the lecture, which is what is the problem with life insurance? It's such a big market, lots of people being insured, but there's something problematic about it. And I would like to express, begin to express the problem of this by reading you a little story with which I start this book. And it's a story that I compiled from real life cases. It's fiction as I write it, but it's based on real facts. And I'll start. Natalie was left with the impression that her life was worthless. That was, in more polite and legal terms, what the letter she had in her hand stated. Years before, she had married for love and given birth to our child, who was now 3. Just recently, she had published her 3rd academic book and had received confirmation of her tenure as university professor. That means she got a permanent position. Her new position allowed her to concentrate on developing some promising intellectual projects she had been postponing for years. Her view on the future was very positive. She had a lot to look forward to. The tenure meant a lot to Natalie, as well as to her husband, who was a talented professional cello player who made a living out of short-term performance contracts. With her secured career, they were now in the position to apply for a mortgage to buy their first home, a dream of theirs ever since the son had been born. Because payments on the loan would rely almost entirely on her income, the bank requested an added security. They asked that, together with a 30% deposit on the price of the house, her husband took a life insurance policy on her life, which amounted to 1/3 of the value of the property. The policy would be payable to the bank in case of illness, preventing her from working, or premature death. It was a way for the lender to offset the risk that Natalie represented to them. As Natalie's financial advisor told them, this was a normal procedure and a common market practice. Getting such policy should be an easy matter. In the process of applying for the mortgage, however, Natalie started to feel ill. She began to experience numbness in her extremities, something she had never felt. After numerous medical examinations, her doctors diagnosed her with an autoimmune disease which they did not know much about. All they knew was that it was degenerative, not fatal, but very likely to create disability. The diagnosis took place just after their financial advisor had made on their behalf the application to the life insurance policy. After submitting the application, the form had followed the normal underwriting protocol established by the insurer. Because of the size of the mortgage, the underwriter required more detailed information on Natalie's health and requested a medical statement from her personal doctor. Natalie had agreed to that when signing the application form. The doctor was asked to complete a form and was asked to send it to one of the company's medical officers. The purpose of this added request was to learn more about the client's particular conditions, a form of micro-underwriting that would help them identify the level of risk posed by Natalie. In the report, the doctor disclosed her condition, and based on this information, the insurer's medical officer advised the company's actuary on the possible implications of her disease for her future capacity to work. The actuary then calculated the risks of the case and calculated the cost of offsetting them against the premiums they would collect from Natalie. He then passed on this information to the underwriter, who could offer a loaded premium to represent her height and level of risk, or could deny cover altogether. The letter Natalie now held in her hands specified the latter. It stated that given her medical circumstances, the insurance company was not prepared to offer her life cover. This did not automatically turn her into an uninsurable client. According to her financial advisor, it could be possible to find cover offered by companies specializing in cases such as these. They operated on a different business model by placing a large number of clients similar to Natalie in a special risk pool and charging them a loaded premium. In so doing, they could offset the losses they were likely to incur in insuring this risk. The higher premiums compensated for the higher risks. That was the logic. Natalie's feelings about the situation were mixed. As a result of her diagnosis, she now found herself living an uncertain present with a precarious future. Her life, which she had understood until then as pretty normal, was now a life classified by insurers as special risk. Standing out in such a way had not figured in her plans. Apart from her and her family's concerns about her health, not being able to secure cover on her life through a life insurance policy, or not being able to do so at affordable prices, would either deny them the guarantee required by the bank as a condition for the loan, or limit what the policy could cover. Without having other property to use as collateral, they could now be ineligible for credit. Another option would be to find a guarantor to the loan, somebody with assets that could be used as collateral and who would be willing to cover the debt in case she defaulted. Her family and friends, however, were not in such a position, so this was not a viable option. Natalie and her family would have to continue living in rented accommodation unless her husband found a way to employ himself in a job with a steady income that would allow them to apply for a new mortgage. In the absence of that, the only other option would be to inherit, borrow from friends and family, or perhaps to keep on saving for a higher down payment. Meanwhile, Natalie continued with her dreams and intellectual plans. She wanted to offer her family and herself the best living conditions possible, and at the same time pursue her intellectual ambitions. For the former, she needed credit. For the latter, the stability that comes with good health as well as financial and emotional security. Being restricted in her access to life insurance cover for reasons that she could not control or change, troubled her. Natalie was now faced with a conundrum: how to live a liberal life in a liberal world where credit is required for the accumulation of capital while being denied access to it on medical grounds. The intricateness of the problem lay in the apparent impossibility to live in the liberal world without living a liberal life. If Natalie were to pursue a liberal existence, she would have to find a way of making herself insurable or finding alternative collateral for credit. If she decided to challenge such liberal lives, she would have to rethink the very terms of her material and productive existence. And then, of course, the story goes on elaborating what this means in terms of liberal existence, liberal life, and so on. But what I've been trying to do with that story is to try to locate life insurance on the everyday, on something that we can all relate to. I myself applied for a mortgage in the process of writing my first book, and many of the things that I know came from that. And I know that, of course, when you apply for a mortgage, it means that you don't have the money to pay up front. We don't have that money unless we have family money. So the interesting process here is that you end up collateralizing your life. But what you're collateralizing ultimately is not your life, but your capacity to generate a future income, your capacity to generate a cash flow that could pay for the premiums in the future. And these life policies go for a long period of time. They normally cover the extension of the mortgage. Could be 20 years, 15 years, 30 years, depending on the case. And one of the things that came into the analysis that I was trying to develop when writing this book was, what is it that makes that person, Natalie in this case, transform something into risk? I'm using this graph to explain this. How do you transform the uncertainty that you see on the left? In that case is the protection of Natalie's income in order to ensure a livelihood and a lifestyle. That's an uncertainty. How do you transform that into a risk, which is known as a life insurance policy? There's something in that question mark in the middle that insurers do in order to translate that uncertainty into a risk. And that's more or less what I have been focusing on in the book. That process in the middle is known as underwriting life, the underwriting of Natalie's life. Now, Something Natalie didn't know at the time of applying for her mortgage was that if successful, if she would get her life policy, she would commit to pay a premium for the foreseeable future. And that policy that she held, that she had subscribed with a particular company, very quickly would be repackaged with many, many other life insurance policies and would be put together into a portfolio that would be sold on. And this would be sold on to reinsurers. Reinsurers would then try to accumulate lots of those portfolios, and because they start accumulating risk and they become very exposed to those risks, then they go and sell it on to a next level in the capital markets. So let me go a bit slower here, because I can imagine not all of you know what I'm talking about. So an insurance company buys some risk from you. You pay the company in order to cover that risk from you. But there's only so much an insurance company can accumulate in terms of risks. There are all kinds of legal implications to this. They need to have some financial deposits to be able to pay for claims if in case needed. So what they do is that once they accumulate an X amount of risk, they sell it on. They get an insurance policy on their own insurance. That's the reinsurance sector. So you have the client, insurance, and reinsurance. And the reinsurers protect the insurers in case there is high exposure to risk. But the reinsurers fall into the same problem after a while. They start accumulating a lot of exposure to risk. And that historically has been a bit of a limitation for the reinsurance industry. How much growth can they afford to have if they are already holding a lot of risk? So what they started to do some years ago, from the 1980s onwards, but mostly from the 2000s, is that they started creating bonds through which they could offset this risk in the capital markets. Bonds are little pieces of risk that individuals, but mostly corporations and hedge funds and pension funds would be able to buy, and they would produce a high interest rate. So 6%, 12%, whatever it is, depending on what the bond is. But in case there is a claim, they would lose the bond. They would lose all the capital investment. And that's a way of distributing the big risks into many, many, many small hands. And the big risks that I'm talking about here are risks that are normally considered to fall within this red region in this graph. It's what we refer to as catastrophic risk. But before elaborating on that idea, I'm going to say a little bit about this. Is this something they're familiar with so far in the course? No, the risk assessment grid? Okay, so I'll explain what this is about. Risk management these days is mainly defined as an exposure to risk understood as probability versus impact. The probability is the likelihood of an event taking place in the future. And the impact are the consequences the materialization of such an event could have. So for example, if you know that it is very likely that there would be rain in October, that's a very high probability, but you know that the impact that would have in the city of Paris might not be very big because the city of Paris is designed to be able to carry out through sewage and so on this kind of waters, the impact is not going to be very big, right? So it might be, you know that if you have some mitigation strategies in place, sewages and maintenance of the system, so on, you don't have to worry too much about that. So that falls into the blue area, which is manageable risk. You can manage them. There are some risks which could have a very high likelihood, but would have a huge impact. And those are risks for which we do not necessarily know how to manage them. What comes to mind if I say this? What would a catastrophic risk of high impact and high probability be? What do you think? Something would be very bad, yeah.
Well, death in the case of the life insurance, since everyone dies or something.
So death, yeah, but the impact would be for, say, the family and those who depend on that income. But that's something the insurance industry has catered for anyway. They would make a down payment and that would be okay. That would be an individual risk for sure. But collectively, what do you think as a society?
Hurricanes?
Hurricanes, oh yes, hurricanes are one of those. And we've had a lot of that We seem to be getting more and more every year. Yes, and those are risks for which we have difficulties assessing the likelihood of occurrence. We don't know how likely it's going to be that we're going to have a hurricane of a particular magnitude in a very specific time, because you need to know when that's going to happen. From now on, we kind of expect that there will be hurricanes, but we don't know where exactly and of what magnitude. Definitely, that's one of the catastrophic ones. And what else comes to mind? Terrorist attacks, for example? Yeah?
Earthquakes ineffective.
Earthquakes, absolutely. Mexico City being one of the, well, Mexico in general being one of the big cases for that. San Francisco, for example, we know that earthquakes will take place wherever they have taken place already. We just don't know when and with which strength. But those are risks that are considered to be incredibly high. The likelihood of occurring is high. We just don't know exactly when, and the impact can be catastrophic, to the point that we might not even have the reserves to cover for that. Because of that, particularly that situation, because the costs of recovering from those events could be so high, and they might overflow the capacity of the insurance and the reinsurance industry, some mechanisms have been put into place. In case of terrorism, there's some insurance state schemes that have been developed, but I'm not going to say much more about that today. But in the case of a pandemic, for example, a health issue, say SARS, as it was some years ago, or bird flu, suddenly there's a pandemic that can kill an enormous amount of people, and the consequences could be so dire that financially we wouldn't be able to cope with this kind of things. What insurers have done is that they have created these catastrophe bonds, CAT bonds, which then they go and sell on in the capital markets, and in doing so, they provide an added layer of security. So in case there's a claim that derives from a pandemic, people making their own claims, the life insurance policies, for example, or the health policies, then they claim that to the insurers pay off, but then they charge to the reinsurers, because of course the reinsurers hold some of that risk as well. And then the reinsurers, once they reach the limit, go and start collecting the money from the bondholders, right? That is an added layer of security that they have built into the system in order to be able to cope with this kind of situations. In the specific realm of life insurance, since 2010, it has become quite an urgent matter, and they have created some schemes. In the case of Swiss Re, they created two, one for extended vitality, so people living longer, and that of course has a consequence for the health sector. Say that you hold a life and a health insurance policy, and the expectation is that your life will finish at some point, right? But we're living longer and longer for all kinds of reasons. And we're all very happy with that, and we're very happy within our families, but that is costing a lot of money for the health sector. So where's this money going to come from? And if more people are living longer, then that creates a big problem. So they created this scheme whereby they can, in the same way that I just explained with catastrophic risks, they can expose this to the capital markets.
Could I ask it?
Sure.
A couple of questions. One is, how do we start to differentiate between different likelihoods? I mean, pandemic risk is essentially very unlikely, isn't it?
Yeah.
Even though the impact is very high.
That's right.
So it's still, that's difficult to compare with hurricane risk, which is higher likelihood and also high impact.
Yeah, it's a very good question, because when I started looking into how do they go assessing the risk, what I find is that, of course, they need to make some predictions. They need to, well, insurance operates on events they can insure for, an insurable event. And the crux of the matter is defining what that event is. And they define it in terms of something that they think can happen in very specific conditions, in a time frame and in a geographical location. So pandemics, for instance, that is a big problem, because pandemic, how do you delimit the area where that can affect, and so on and so forth. But the methods through which they do this is using what they call risk modeling. And modeling is basically making some decisions right now on what is it you're going to project into the future, for then going to assess how likelihood that event you have created imaginarily is going to have and what the implications would be. So it takes a lot of decision making on a particular moment in order to project this. And these decisions are based on the information they have at their disposal, but it's mainly mining the past, trying to see what has happened. So in terms of excessive deaths, the cases that we have in history are mainly from the world wars. And a lot of people who died the Spanish flu after the First World War and so on, and that left some data which is taken as an event that they can draw on, and then they project that into the future. But of course we know that the circumstances for those historical events have been very specific. And to project them into the future creates all kinds of problems. It's assuming that the conditions would remain stable, ceteris paribus, as economists would call it, and it becomes incredibly problematic. Here, when I speak about the problem with life insurance, the ways in which it values life, it has to do with that. The methods through which insurers assess the risk are stochastic models that actually project into the future something that they define in the present, but it's highly controversial. The problem is that we don't have access to how that is done usually. It's never going to be a democratic process or anything. It's a technical matter, but it's not open to scrutiny either. And yet we rely on the decisions that are being made on that form of modeling. I have a question in the back.
Yeah, I want to ask about the logic of this graph, because I would have thought that insurances work with expectation values, which is the probability of a certain event multiplied by the costs of that event. So I would have expected this graph to be in a hyperbolic or with hyperbolic borders.
Right.
So what's the logic of having a catastrophic risk, for example, for a very low impact with a high probability? I mean, this doesn't create much costs for...
So finite impact is understood as cost.
Yeah,
right?
It could be, yeah. And you're absolutely right. I mean, this is a kind of idealized model, right? This is the kind of stuff that many risk management companies use and board of directors and so on. But in reality, it never really moves in this way. And the borders will never be squared. It would also depend on the specific circumstances as well. What we do know is that, and this is normally why this kind of graph is used for training risk managers, is that the idea is always to push that blue area into the red area. And the hope is that by creating this catastrophe bonds and many other strategies that they develop, is that they will be able to reduce the catastrophic risk area to the minimum and try to make everything either negligible or manageable. That is the hope. So this is an ideal situation, but in reality, usually doesn't work that way. So you're absolutely right.
So other determinants might be local values, cultural traditions, resilience of families.
Exactly.
That would all contribute to shaping the graph.
Absolutely. Yeah. So the typical case of microinsurance is illustrative in this respect that say that, well, after Hurricane Katrina, massive event that created a lot of insurance claims, almost in the same year that the Indian Ocean tsunami took place, that created an enormous amount of deaths, but not so many insurance claims. So the debate at the time was, so the area of Katrina, still being one of the poorest areas in the US, but it was heavily insured, and therefore there were means with which to reconstruct at least big parts of it. In the case of the Indian Ocean tsunami, a much vaster area where many more people died, there were no financial means to recover it because the capital had not been insured. So the reasoning behind this is capital got lost. So you need to start accumulating again and start from scratch. The rationale of the insurers and the global reinsurers was, well, we need to go and sell them insurance, right? We need to expand the frontier of insurance and make them insurable. The expectation was that micro insurance would be the solution because people would not necessarily want to go and insure their houses or this and that, but pots and pans, or their instruments or working instruments, or their basic possessions, which for us would not mean a lot, but for them would represent a lot of importance in their livelihood. Yeah?
The question about this high cost which could be generated by catastrophic risks wouldn't be a very easy way out for companies, being insolvent and being bankrupt. So is it actually governmental laws which force them to have a sufficient amount of money available, or what is it?
It depends on the sector as well, but yeah, in many cases this is regulated, and depending on the service that they provide to, and the size that you hear all the time on the press that certain banks are not allowed to grow bigger than what they are, or insurance companies and so on, because they don't have enough reserves, for example. That has to do with that. But the interesting thing here too has to do with, for instance, if you know that insuring against hurricanes and earthquakes and this kind of things in certain parts of the world might actually be a pretty bad business. Say that selling hurricane insurance for Florida, that probably doesn't sound as a very appealing business. But then the state of Florida, which is a big institution, can say, well, if you want to operate, if you want to have a license to sell insurance in this state, or if you want to us as a state to buy policies, you need to make this kind of services available as well. So you always have the sovereign power intervening as well for certain lines of business. But okay, let me move on with this now, which has to do with, okay, this is the logic of insurance. And in the story of Natalie, I was trying to exemplify that by saying insurers always say, we just price the level of risk, right? We're not inflicting any damage on you, or we're not being unfair or arbitrary here. Mathematically, this is the level of risk you represent to us, and therefore we charge you accordingly. That is the idea. In my book on Insuring War, I have a case of insurance against maritime piracy, which exemplifies that as well. You can look at it if you want. But okay, so this is the rationale: the right price for the right level of risk. So the idea is that if the level of risk changes, then you pay less. Or you can also have some creativity there, is that you package all these special risks, which might be higher than normal, and by pulling them into a risk pool, a population of high risk, then you might be able to insure them at a beneficial rates when put together somehow. There's a lot of creativity within that. Okay, that's what they do. Fine. But what we would like to focus now is, what are the problems with that? And are we all docile bodies that allow our lives to be valued in such way? And do we just follow suit in such an easy manner? And what I found when writing this book is that it's definitely not the case. There's always resistance to life insurance and to health insurance. Sometimes it's explicit, sometimes it comes through the form of court rulings, sometimes it comes in popular culture and so on. But there's always resistance to this. And it's the case of Natalie, who says, well, what I'm really concerned about is my intellectual life and the well-being of my family. It's my genes which I cannot control. That's not something that it's my fault. It's not a moral hazard that I'm representing to the industry, and yet I am rendered as uninsurable or underinsurable, and therefore I am affected in my liberal livelihood, right? So this creates resistance. One case that I explore in the book has to do with the case of what I call the stability of genders in society, and was a case of the insurance industry being affected by a decision from the European Court of Justice. So there was, I think it's 2004, that the European Gender Directive was issued, and in other words says that you cannot discriminate on the basis of gender. But there was an exception that they allowed if an industry could demonstrate that they had clear grounds for which to distinguish between genders, then they were allowed to discriminate for as long as they were able to demonstrate it. Had to be proven. The financial industry made the claim for the insurers that insurance was one of those cases. Typical case, drivers between age 18 and 25, male drivers, they claim, were a higher risk than female drivers, and therefore they should be allowed to discriminate. Another one was that women tend to live longer than men, and therefore life and health policies should be priced differently because the risk for the insurer would be different as well. And for some years, that's how they operated. But in 2012, 2011, I think it was, there was a ruling that came out, I think it was in Belgium, by an association that took the case to a local court, and then that court took it to the Constitutional Court. The Constitutional Court said, I cannot rule on this, I have to pass it on to the European Court of Justice, which was a case of intersexuality. An individual who, on the basis of being intersexual, was denied a particular form of insurance cover because it didn't fit, right? So the question is male or female. It's a binary. That's how it's being asked. And if you don't fit into one or the other, then either you don't exist for that system or you're forced to fit into one box. In the case of intersexuality, it's incredibly complicated because it's the grounds on which sex in that case is decided are very, very complex. And I go into some detail in the chapter that I explained that. The end result of this ruling was that that exception that the insurance industry had been allowed to have no longer applied. So from I think it was 2012 or 13 onwards, they could not discriminate on the basis of gender any longer. And I was speaking with many insurers at the time. I even spoke with some people in the insurance lobby in Brussels, which is enormous, to try to understand how the industry would reaccommodate to this situation. Many were dramatizing it in the sense by saying that it's the first legal ruling that really affects the structure of insurance ever since the 18th century. And there was an interesting case there that I can tell you about later. Some were saying, well, gender goes now, the next thing to go is age. And if we cannot ask people what's the gender and what is their age, then we won't be able to assess the risk in terms of health and life and some other kind of products. Age is also a very problematic issue because it's now argued that we don't age at the same rhythm, and not even parts in our body age at the same speed. And yet we are individual under a name Alex, who is age 32, who was born in a particular place, and that constitutes our identity. Now, for this kind of instruments to work, you need a stable identity. And the same for the state. That's why states put so much emphasis on your name and your identification. You are meant to be an individual, and you're meant to remain an individual. And when you challenge that individuality, or you claim that actually you can be many things at the same time, that does not fall within these technologies of governance, and you create a big problem. And yet, the reality is that a lot of the dimensions of our own life are not individual, and they're not individualized. And a lot of people in the world do not fall into this kind of categories. There's a form of violence that gets inflicted in forcing these things to happen. Yet it is a condition of possibility for the insurance technology to operate. Another one has to do with what was presented as the case of uberrima fides, that's utmost good faith in Latin, and the problem of asymmetric trust. Basically, the mis-selling of insurance products. That somebody comes to you and tells you that they're going to sell you this insurance product, you buy it thinking it's something, and when you make a claim for that something, they tell you, actually, no, that's not what you bought. But most of us are financial illiterate. We don't know much about those kind of things. And if they tell us something, we act in good faith and we go and buy something which ends up not being a protection for the event which had been, that we had in mind we were insuring for. And that created all kinds of debates and legal rulings, particularly in the UK, during the time in which I was writing this book. And it started to put pressure on the insurance industry to argue why is it, well, first of all, to be very clear on what is being sold, but also to be very clear on the grounds on which an insurance claim is being denied. And, because I'm running a bit short of time, I'm not going to get into the details, but there are all kinds of wonderful examples to mention there. The last one I'm going to mention quickly. Is anybody familiar with a film called Code 46 by Winterbottom? the same as Minority Reports in Gattaca. Oh, highly recommend this. It's wonderful. It's an idealized, fictionalized world, often ruled by insurance, where even access to different parts of the world when you travel depends on having or not insurance cover. And you don't travel with passports anymore, you travel with a credit card, which glows. If it's blue or green, then you're safe, you're covered, right? But if it starts turning red, that means you're reaching an area where you're not going to get covered. And if it's red, you're uncovered. And that means that you can be expelled from society and all kinds of things. So you don't want to test that system, you always want to be covered. But what that film does in a very creative way is that it highlights the big problem of desire versus insurability. You have desires that might not be physically possible, might not be legal, might not be moral, might not be tolerable, and yet they remain desires. And they capture our imagination, and they fuel our will to do certain kind of things. And in the case of the film is this fellow who wants to go to a particular part of the world to see bats, because that's what he wants to do. And he does all kinds of tricky things to go and see the bats. The problem is that he himself would not have covered to go to that region. They wouldn't tell him why. But the Sphinx, which is the insurance company, says, no, you cannot go there. It's not that the region falls out of a safe zone. It's just that he is denied access to that particular region. And then when he dies and so on, they say that he had a susceptibility to a disease that was carried by bats. So the insurance company was covering him, was protecting him. The Sphinx knows better was the slogan and so on. Anyway, I used that case of Code 46 to dramatize the case of desire a little bit here as a form of resistance to life insurance, which is quite prevalent in all kinds of real-life cases. Now let me get into the substance of all this. Remember that I told you that the thesis here is that what life insurance does really in terms of to support liberalism is that it helps it transcend. So how is this possible? How does life insurance contribute to the transcendence of liberalism? So I need to say a couple of things about transcendence, and I can spend a whole week talking about transcendence. I'm going to keep it very simple here. To transcend, basically put, is to go beyond the current condition, to exceed it, to surpass it, to go beyond. A transcendental creates a world, and it's a way of looking beyond all the time. Use the metaphor, for instance, of the horizon. And there is this wonderful anecdote of a case, and it was Reinhard Koselleck in one of his books who uses this example. He says Nikita Khrushchev was addressing his comrades in a big communist rally. He says, "Comrades, communism is in the horizon." And everybody cheered, yay! Somebody raised their hand and said, "Well, comrade, what is a horizon?" And Comrade Khrushchev said, "Well, look it up in the dictionary," which he did. And the dictionary said, horizon, that which recedes as you approach it. So communism is in the horizon, right? It keeps on going. Well, it's the carrot and the stick. So you tie the carrot to the stick in front of the donkey, and the donkey keeps on walking because it's a carrot, the stick, but it keeps on receding, receding, receding. Well, that's a way of transcending. It's a mechanism to transcend. And we have various examples in history of how different societies and civilizations transcend. Now, what I argue here is that life insurance contributes to the transcendence of liberalism. And here I'm being incredibly wide, because liberalism can be many things, of course. But I argue that it contributes to the transcendence of liberalism by producing three particular conditions. One is that it produces subjectivities that stabilize the idea of the human as indivisible and responsible. So Natalie, being called Natalie with her surname, with a particular age, hopefully with a stable domicile, and so on. And that's a Natalie which is the same Natalie today, and hopefully will remain the same Natalie in 20 years when she's still paying her insurance premium. Schizophrenia would be something that insurers would have a lot of problems with, because that would not be a stable identity. The moment you start challenging that identity, then you have problems. The case of inter-sexuality, for example. Well, the second point, and this is very quick to make it this way because it's a very rich point too, is that insurance produces time. Insurance creates a time. It's the temporal framework in which uncertainty is managed as risk. And the time of the insurance is a time of a continuous present. You never insure in the future. You never insure in the past. You're always insuring in the present. You're always living on the present. It's a perpetual present. That is when it becomes very interesting to see that that present is made possible by understanding events of the past and projecting them into the future. There is a logic in a contradiction in the logic through which that operates. But the time of insurance, insurential time if you want to call it that way, is a continuous line of presence. The third point here has to do that it produces markets of security as the instruments through which it governs the behavior of individuals and collectives. Insurance produces markets of security of securities in different ways. One which I mentioned is packaging insurance premium policies into portfolios that are then traded with, and they're traded on almost infinitely. It's difficult to know exactly who holds your own risk because it has been passed on. There's a legal trace, of course, that you can use in order to know how that comes back to that. And because it produces a market, it becomes very efficient in the delivery. We know that one of the, let's say, advantages of capitalism and within liberalism is that it creates markets as logistical spaces that allows us to allocate resources allegedly in an efficient way. And the idea of that is that you create a market that is operated through the price. So once you create a market, the idea is that price, and this is Foucault who argued this, price becomes an instrument through which, a device through which you can make the market work. Of course, we know very well that there's no such thing as the invisible hand, that this is highly orchestrated, governed, intervened, regulated, etc., etc. But what insurance does is that creates a market through which it can govern uncertainty. And this becomes a very efficient system, also because it becomes profitable. It becomes incredibly profitable and almost infinitely profitable. The barrier, which is pushing that blue line, the blue line towards ad infinitum to cover all the catastrophic area is endless. You can just have to be very creative in order to be able to make that happen. I want to leave you now, because time is almost over, with three thoughts to conclude. And these are very general thoughts. The first one is, okay, as a researcher, why should we bother studying life insurance as a political site, right? I've written 3 books on that. I do all this stuff with it. But why bother? Why would you bother? Or why would others bother? Well, to explore how it creates order. It creates a lot of order in society. Fire insurance is another example that actually regulates how the setup of buildings inside and outside has to be. And the very design of that has to do with fire insurance. But also to understand how power is exercised in non-public spheres. Most insurance, at least the one that I have been researching, is private. And yet it does rely on the public sphere. It requires the rule of law, of course. It requires courts, operating courts, and so on and so forth. But it's a form of power that is not directed by governments, by political parties, by national assemblies. This is private power, and yet it has public implications. So it helps us challenge that binary between the public and the private on which most of our political theory operates. And thirdly, to map how, where, and by whom is governance produced. And this has a resonance with geopolitics that I'm going to mention at the end. Second question here is, what are the implications of arguing that life insurance contributes to the transcendence of liberalism? Now, after having written that book, it's a question that I keep on trying to answer for myself, because the implications are very, very big. But just three sketches here. One is that insurance provides liberalism with a technological agency. As a technology, it is consistent and repetitive. It's the consistent and repetitive application of the rules of a logic of risk management. So as a technological agency, for as long as the machine carries on producing what it's expected to produce, you're going to have an outcome. It's the bicycle pedaling. This logic responds to a particular way of understanding the life that is to be protected. a life expressed in terms of a particular understanding of value. We might challenge it as much as we want, but it works for them. How does it work? It makes money, and they're able to repair financially what they are insuring for. However, such understanding of value is not universal. It is not indispensable. It could be otherwise, but only if we think it outside of this liberal system of thought. This is deeply implicated with this system of thought, liberalism. Liberalism and insurance go hand in hand with its application in capitalism, of course. If we want to think it otherwise, we can do it, and we can live parallel lives, alternative lives, but they might not be liberal lives. It's what I finished my story with when I was speaking about Nathalie. Yes, she can decide to live otherwise, but she might not be able to live the way that she has normally been living. Her lifestyle and her livelihood might operate slightly different, which is the reality for many people in the planet, probably not us here in Paris, of course. So the challenge is, and the challenge I would like to leave you with, because of the nature of this course, geopolitics and risk, is how can thinking about life insurance, or insurance in general, help us understand contemporary geopolitics? And an argument one can make, and this would be a wonderful PhD thesis, by the way, is that insurance creates spaces of governance which are not territorial, which are not localized, which are not logisticized, but they're very specific spaces of governance for which I feel we do not have a vocabulary to refer to. So this is the space where geography, and particularly geopolitics, could become incredibly interesting to explore these spaces of governance through which we control this big part of the world. So I'm very open to questions or discussions that you might want to exercise, and I see you're bursting for one.
So far you've been talking about private insurances, right? So life insurance as offered is at the moment private.
Yeah.
But thinking about health insurance, for example, there's a series of nations which have national health insurance systems which work on a completely different basis, which actually manage without classifying the people, but there's a standard amount of payment, namely tax, going into the system, and people are covered by this. So how do you relate those systems to what you've been presenting today?
That's a very good question, and you're right that different countries have different systems. One thing would be to explore this in the case of the United States than to do it here in France, right? Different principles operating there. Let's say the case of France, which actually I only know in its generalities, I must admit, is a system where there's a principle of solidarity involved. So the idea is that everybody gets covered, right? And you fund that through the public purse. And you fund it even if you're contributing to the system or not. It's a principle of solidarity. Another system would be that you only get covered for as long as you are contributing. That's a typical private scheme, where it's operated under a principle of mutuality. So you mutualize the risk. You're only covered if you're part of the club, right? And you have countries where it's a kind of a blend between the systems. It's privately offered, but there is an obligation for everybody to have some form of insurance, and you might be provided with a very basic, and then the extra you would have to put to yourself and so on. But the mechanism is slightly similar in the sense that you have to constitute risk pools, and you collect premiums for it, which once you start collecting the money either through taxes or through private contributions, you need to do something with that money. And I was speaking with somebody last night who works in the Council of State here in France, and he's in charge. Well, he works in the financial part, and he was telling me that one of the things that would be ideal in a market economy like this one would be that insurers would be a bit less conservative in the way they spend that money that they get, right? Because then they could dynamize the society, the economy a bit more. But insurers traditionally, what they have done, and here I'm talking from the 17th century onwards, is that they invest in very stable outlets. For instance, government bonds. navy bonds in the case of Britain, the 17th century onwards, and pension funds and these kind of things, which are relatively stable. They don't produce a lot of interest, but they're stable, they're safe, right? The idea is that they need to operate in such a way that, because in case they have to satisfy claims made to them, they should be able to bring the money back and put it in. So in that sense, it operates quite similarly. The difference is the profitability of the scheme, right? If you have a private insurance scheme, you can limit it as you want. You can compartmentalize it, divide it, and make a lot of income in some areas, not so much in some others, a medium in the other. You have different portfolios, but in the state insurance system, you have an average. By the way, in terms of that, something interesting is the writings of Franz Kafka on social insurance. A few people know that Franz Kafka's day job was to be an insurer. He used to work for an insurance company, a state insurance company in Prague, I think it was. And he was bored to death with the whole situation, but bored in a way that was very productive. He would reflect very critically about this kind of things. Of course, we're talking about a different kind of historical period. Anyway, that's anecdotal. I can tell you more about it in some other time. Does that answer your question somehow?
Could I repose
Different
the question?
principles.
Yeah, but I mean, the same question in a much more simple way. Does the privatized insurance regime govern security, the security of the liberal order, like you were saying, in the same way that a public one does? So take the extremes, the United States model and the French model. Are they governing liberalism in the same way, but different places on the scale, on the continuum, or is it a heterogeneous systems?
I would say that they all govern liberalism, but they do it in different ways. Hence the idea that we have parallel liberalisms, different liberalisms. Right. Even if you take the case of Britain with the case of Germany or France, they would be slightly different. Simply because they impose different kinds of restrictions and they stimulate behavior in slightly different ways, depending if you are only allowed to get certain services if you contribute to the pool, you're likely to behave in a particular way, different than if you have universal cover, that you don't have to do anything to get it. So that's what I mean by that. But in order to look at the details, then we would have to analyze specific cases, of course. But yeah, I would argue that it still creates a form of governance, which is liberal in general, but it creates different forms of liberalism. A comparison that has been made has been between, for instance, the creation of the Bismarckian regime in Germany in the late 19th century, and then the beverage regime in the UK in the 1920s, in the interwar period. You have different liberal subjects that result from it. Some people argue that the subjects that resulted out of the Bismarckian case were conservative pensioners who don't rebel, and therefore you don't have the myth of 1848 running around, and the risk of a revolution. In the case of Britain, is you have a working class that can look after itself. You don't have to provide it with, and therefore it won't rebel as well. But different schemes through which you do that kind of stuff.
It's very interesting. Personally, I lived in 3 different regimes of health insurance, one in the United States and one in Norway, and then now in France for the last, 2 years. And it's a completely different feeling of security that you have. In the United States, if you need an MRI scan, one of these big scanners they put you in, the doctor will say, we'll give you an MRI scan, here we've got one in the next room, and then you go in the next room and do the scan, and then it's extremely expensive. And it goes on a private insurance. In Norway, they have 6 MRI scanners in the whole country. So the insurance pays for an airplane ticket for you to go to Trondheim or wherever else you might, and they put you in a hotel and pays for that. And then you have your MRI scan, and then you go home. And here in France, it's a bit more, well, there's one in every neighborhood, maybe.
Right.
So there's something in between. But it gives a level of luxury, a feeling of luxury and spontaneity of medical care, which is very different in the 3 settings.
I found that very interesting in terms of the way in which uncertainty is understood. So it's not only the delivery of the service or the access to the service, right, and how you get to that, but how is it that there is a politics behind that problematizes that uncertainty in different ways? In some places, these kind of services are seen as a right? Of course, you need one, you get it, right? In others, it's seen almost as a luxury. Can you pay for it? Can you get into that? But there are political processes behind one and the other. I sometimes wonder, why do they not rebel, for instance, in the United States, saying, well, it's almost a human right to have access to these kind of things. But it doesn't happen. Different political processes involved. That's a great case.
If there are no questions, could we go?
There's one in the back.
Yeah, I had a question about the graph you showed in the beginning that showed the weight of life insurance premiums versus GDP in a series of countries, and you showed that in the case of China, it increased quite significantly.
This one. Yeah.
And China does not strike me as a liberal country in any sense of the world. It's not culturally liberal, it's not economically liberal, it's not politically liberal. So how would you explain that when you say that it's a part of a process of the liberalization of China, or is there simply another meaning in the Chinese civilization to life insurance?
I was in China in November and December, and I was quite shocked to see what I was exposed to. I actually see that there is a form of liberalism there. Slightly different, actually very different from the one that we're used to around this part of Europe. But it's a liberalizing economy with different political regimes, of course, and different understandings of human rights and so on. And actually a very different kind of politics of uncertainty behind this kind of processes. China now has a very strong middle class, and when you have a strong middle class, you have a big problem, which is that a middle class always wants to go higher, always wants more, wants better, right? It's the little carrot in the front. It's always trying to transcend its own condition, and it puts demands on its governments and so on. And that is a factor, one of the factors of economic growth. If a regime or an economy cannot satisfy the demands of that growing middle class, it can face all kinds of turmoil. And that, I think, is one of the biggest fears of this kind of regimes, when we still see the growth levels of China are still quite significant, but not as they used to be. And that's a cause for worry. So what I mean by liberalism here is that, and the same could be said for Russia, for example, which some people might not agree that it is a liberal regime. Some others would say we're talking about different forms of liberalism here, different forms of liberal regimes. That's more or less what I meant by that. But the observation is very right. One of the biggest growing markets at the moment, from what I read last night, is India. It's growing very, very quick. And it also has to do with the growing middle class and the growing population. You had another question?
Yeah, one is directly related to this graph. The obvious peaks in the UK, did you talk about those?
Here we're talking 2000, I think it's around 2006-07, where you have that big peak.
Yeah. 99 as well.
Yeah, I don't know the details, to be honest. That's interesting. Would be interesting to see. The only reason why I chose this was just to demonstrate to you that there's a lot of money being put into it. But there would be something interesting to look into as to what is this evidence of, the peaks and the valleys that we see in this kind of graphs. Because, of course, if we live in a situation of heightened uncertainty, we might seek forms of protection. Maybe there is more desire to buy this kind of product. When things seem to be relatively stable, say, nah, why should I worry too much about that kind of stuff? But that's worth investigating for sure.
Well, doesn't it correlate, I don't know about the first peak, but the second one with the economic crisis in 2007?
So we have, the first one is 1994, more or less. Then we have around 2000. 2004 is a valley, and then 2006-07 we have another peak. But it doesn't always coincide. In different countries it operates slightly different too. Yeah, we would have to look into the details in order to understand that. Internal political processes as well, etc. Even environmental issues. That's something that can count as well.
Or fear.
Fear, yeah. You wanted to ask something?
Yeah,
Or say something.
I think we should, especially in linking to the risk and impact, the likelihood impact graph, which is, it's very useful pedagogically too, but it's very problematic as you were saying. And I also think you could criticize it to the degree that the impact of foreseen risk is also partially dependent upon the likelihood. So higher likely events causes a greater impact of emotional fear. So there's a third dimension you need to even. But what I did want to bring to this was to ask you a question, was that about the terrorism, which you didn't really talk about too much. And when we're plotting terrorism onto this table, on this graph, what kind of impact are we talking about? Are we talking about actual material impact or impact on society? Or because terrorism, of course, has such a strong imaginary impact.
Yeah.
It has enormous force, political force too, but it's not really because of the actual destruction it causes.
And usually not because of the number of casualties it creates.
No.
It's I saw some studies last week. One of my students was presenting this, and she was showing how the insurance industry perceives the bigger risk. What are the big risks that the insurance industry considers? Terrorism comes quite low. It's mainly environmental hazard at the top. Those are the big fears. And we hear about hurricanes, and we hear about earthquakes and so on. Those create the headlines. But things such as mega waves, for example, meteorites crashing against the planet, well, we hardly ever hear about those kind of things. But those could have massive consequences.
But are they based on facts, or are they based on what the market will bear, what people will be willing or stupid enough to buy? I mean, if the public is more worried about terrorism, then they can sell terrorism insurance.
Right.
Which is not even based on facts.
But it also depends. So remember when I was saying that you have to, there is this, what I said about the 17th, 18th century, that was a big sovereign intervention in the practice of insurance, is that there's an act of parliament in Britain that forces insurers to be able to demonstrate that they are insured, that those who are insuring have an insurable interest. So you cannot insure as an individual for a terrorist attack in New York if you don't have property in New York, or if you don't live there, and so on. It's defining that event that you're insuring for, and you have to have a direct provable interest on that. The problem then is, what is the event that you're insuring for? Is it a dirty bomb exploding in the middle of Paris, which would have catastrophic consequences for the time to come? Or is it a small improvised explosive device in a bus in Paris, in a particular neighborhood, right? That would create a lot of panic and so on, but the impact of the one and the other are very different. We both call them terrorism, right? But it's an umbrella concept, which is really not. What insurers do in order to make those kind of things insurable, the same with earthquakes, is that they don't insure against earthquakes or against terrorism. They insure against specific events that might derive from a terrorist attack or an earthquake event. So in the case of Mexico City, was that we know that in 1986, Mexico City was almost flattened by a massive earthquake, and there was not enough money to recover it. And then the government created a fund that would put money every year for the next reconstruction. But there was always an urgency that would take money out of that fund, and there was corruption, there were other things. So that didn't work. So they created catastrophe bonds out of that for recovering for the next catastrophe. But the way in which those bonds operate is that you're not insuring against an earthquake, but you're insuring against a parameter. So the parameter you insure against is that there would be a telluric movement, a shake, of over 5 points on the Richter scale in a very specific determined area, which has been drawn, right? And you need to have an objective market institution to verify that that was the case. In this case, the U.S. Geological Service. So if there's an earthquake in Mexico City of 2 degrees, that was not the event that had been insured for. But if there is a movement, regardless of what it destroys or not, there is a movement of that degree in that particular place within the period of time that had been specified, then there is money to be paid to reconstruct, to do whatever the government needs to do with that money, regardless of destruction or not. So that is what they call parametric insurance. So the same thing has been applied to terrorism and so on, what you're really protecting is the assets that could be destroyed in a built environment, or the business continuity of companies that would see their activities disrupted by other people being killed, for example, or not being able to access the facilities, or the information being compromised, and so on and so forth. So it's always about defining the parameter out of which an insurance claim could derive. So that's how they deal with this kind of things. It's also speak about terrorism and earthquakes and this kind of things, or pandemics. They call it different. They are all about being able to measure it, right? But politically, it's interesting, though, because the amount of death that result from terrorist attacks, and this is, by now, I think it's almost common knowledge, they're very few, but they create a huge fear in the population. How do you insure for that? Could that be insurable? What about values such as trust, confidence, those kind of things that cannot be insured? And yet we require them in order to have a working government, or to have an financial sector or society.
But even more relevant, because you could say, if the hypothesis is that insurance is sort of the foundation of liberal society, that it guarantees the security of liberalism, that to the degree that symbolic threats, immaterial threats to liberalism, like loss of confidence in the market, are the real security problems of liberalism, then how do we insure against those? Can we insure on the basis of loss of confidence? Can we insure on the basis of fear? And has that been done? Can you get fear insurance? My great grandmother had a heart attack when the Titanic died in Berlin. Could she have had a life insurance policy or an insurance policy for a catastrophic boat sinking?
I don't know. I mean, insurance are incredibly creative, and they can sell the insurance for pretty much anything. You come with your worry, or you come perfectly tranquil to them, and they make you worry, and then they sell you something for it, right? They create a need. But I was going to mention something that happened, I think it was last week in Catalonia. It has to do with, that this independence process that is taking place in Catalonia, which is very controversial, and it's creating all kinds of discussion, still locked into the binary distinction of yes or no, independent or part of a state or what. Still locked on that, which is a problem. But suddenly, out of the blue, we get a headline that says the insurance company that holds their insurance for the parliament, for the Catalan parliament, the building, and its personnel, has been rendered void by the insurers, because they say the circumstances under which we had insured you have changed dramatically. You now represent to us a much higher level of risk that you are not insured for. And therefore, if something happens, we're not paying. And this is very interesting, because we have a private company that was chosen by a public tender, which has a contract to do that. But what it is insuring is a public entity, right? And it's the conditions under which that public entity, under which it operates, that have changed, that they're now saying we cannot go into that. Now, part of the bottom of it has to do with the security of the rule of law, what Luhmann referred to as the stability of expectations, right? That you require, that you produce through law, through a legal system, in order to be able to look into the future. So if you're making investments or you're insuring, you are expecting things to remain relatively stable. When that rule of law is challenged, which is partly what has happened with this process in Catalonia, then I'm not surprised that the insurers are the first ones to say that you're really changing the grounds under which we operate here. And therefore, either we move away, or we argue that we cannot honor a claim if it happens. They're particularly concerned about social unrest, particularly, So those are the kind of things that you say, okay, well, it's all concatenated, right? So there is some collective fear. There's a huge incognito as to what's going to happen. Companies are leaving the land, and they're trying to re-register in parts of Spain that in principle are not affected by that. And nobody really knows how that's going to go. But of course, there's a collective anxiety that affects the livelihood and the lifestyles of people. I am not sure that is insurable, or if it could be made insurable. Maybe it is, I don't know.
We want to be sure to come back to your conclusion, which is really very evocative, but maybe a question or two on your reasoning. First, could you say a bit more about invisibility? Governance, you said at the very outset, governance is always invisible.
Right.
Or it's not governance. I mean, this is a very Foucauldian idea, as I think you said yourself, that somehow if we can make it explicitly accountable, then it's not governance. How does insurance contribute, or how does that function as invisible, or does it? Did you mean to say that it does function in that invisibility?
Well, what I mean is that the moment you need to get out the police on the streets and beat the people, something is not working, right? But on the day-to-day, like today in Paris, as far as I know, things seem to be relatively normal. We don't see the police on the street, right? We don't see, or maybe they're just patrolling or something, but it's not, they seem to be, they don't seem to be there. They seem to be invisible. They're there though, they're doing their job, but it's not disrupted. The moment that gets disrupted, then that becomes visible. Another metaphor to explain this is you drive your car every morning to work, you just turn the engine on and drive on. You never, you put petrol in the engine every now and then and do the regular maintenance, but you don't think too much about what goes into the engine to make you move from one place to the other. But one day, in the middle of the motorway, your car crashes down. And then you open the engine, you call the road recovery service, mechanic comes and says, yeah, it's the petrol pump that has broken down, so I need to tow you to a garage. And you say, so I had a petrol pump. I never thought about that, right? So it was invisible. It performed a role. You didn't know about it because it was invisible, but actually it was not invisible. It's just you didn't know about it. And that's what I mean by insurance, that in this room, for instance, you see this, where are the sprinklers? We don't see sprinklers. They're probably hidden. Right, they're fire alarms, right? And you have fire alarms, and you would find doors that need to be closed in corridors and so on. Those are fire blockages, whatever you call them, fire doors. The windows would have a particular design. The doors are designed to keep fire in as well, and so on and so forth. But those things are expensive. That costs money. And I'm sure architects would like to design in slightly different ways if they wouldn't have all those kinds of restrictions. So we as everyday users of this building do not notice those things. They're just invisible to us, but they are performing a role day on day. That's what I mean by the invisibility of governance. The thing is that our conduct, our behavior as individuals, but also our collective behavior is framed by all those kind of things that we normally don't reflect about. So I ask my students in other courses, why did you sit where you sat, right? Why are you sitting there? You could be sitting here, but did you sit in the first place? Who told you to sit, right? Why are you not lying down? Why are you all facing the lecture and so on? Well, there are conventions involved, right? There's traditions. But to be more mundane, there's furniture, right? If we had accommodated the furniture in a slightly different way, or removed all the desks and all the chairs, and everybody comes in, probably kind of start roaming around and not really knowing where to locate yourself for the lecture. You might even ask, is there going to be a lecture, right? This doesn't seem to be disposed as a lecture room. But it's this kind of things that frame silently. We don't see them normally. We don't question it. But they're actually affecting governance. And our behavior is the effect of that governance. So we're being acted upon. We're being subjectified. Usually as silent subjects. We just follow what is being done on us because we don't notice it. So that is what I mean, that insurance is a technology of governance that is usually unnoticed. It does all kinds of things to us, which I am absolutely sure many of which are very good, because they allow us to do certain things, to have a particular way of life against which we haven't rebelled. So we, in principle, are obedient to it, and we find it desirable. But in other cases, it's doing things that actually we might find questionable in the process of making them explicit. For instance, the case of modeling that I was mentioning there, that I write on the book. I find it highly questionable that a very specific understanding of history is being imposed on us, and we don't even realize that that is the case. Please.
Could you elaborate, please, on the geopolitical side of life insurance and how it creates spaces and different spaces?
Yeah, I definitely wanted to come back to that.
That's very juicy and very exciting. It's something that I only started thinking of today when I was preparing these slides, because I thought, well, this is a course on geopolitics and risks. And I actually run a master's degree at my university, which is on geopolitics and connectivity. But I hadn't made the connection between these technologies of risk and the creation of spaces of governance.
It's also, in parentheses, it's a very French question from geography. It's a very...
Is it?
That's one of the joys of my discovering geography in France, is that you asked exactly this kind of question. So
wonderful.
So the geographers in the...
Yeah, it's a great question. I mean, you can do this, which is traditional geopolitical reasoning, right? To put this kind of graph and say, this is where it's growing. But having grown in a country like Colombia, you realize that there are parts of areas of the city of Bogota which are heavily insured in all kinds of ways. It's like being in central Paris, but parts where insurance is not even known or it doesn't operate. You see the behavior of some individuals which is seriously shaped by insurance products and practices, in most cases invisibly. Others where that wouldn't matter at all, and yet we're talking about a geographical space, right? But that's not the space that I'm talking about. So it's not this kind of graph. It's neither this kind of graph, which would show us the financial permeability of a product within markets, right? It's neither this kind of graph that would show us, let's say, the geographical concentration of insurance in 80% of insurance in, let's say, the rich parts of the world. That says something. We could talk about a geography of insurance there, but I could talk more about a geography of a politics of uncertainty there. But what I was thinking more in terms of that is, I think there is a particular spatiality that results from these forms of understanding uncertainty and risk, which these are spaces that we inhabit, where we exercise our, well, where we are, our being takes place in specific spaces, but they don't necessarily have to be physical, and they don't have to be located, so they can move around, right? If I am, the typical example here would be us traveling to different parts of the world with travel insurance. So travel insurance is something that travels with us, right? It's not going to go and fix the context in the place where we're going to go and visit. It might be a very a region at war, for instance. Still, we will be able to get cover at a price to go there, but that insurance travels with us, right? It's not necessarily located. It's influenced to where we go and so on. But that's more or less what I would like to reflect on. What is the kind of space? What are the particularities of that space that result from this kind of practices? Maybe we'll do our workshop on that someday.
But isn't the example of the film you mentioned,
yeah,
isn't that exactly Code 46?
Code 46, yeah.
Isn't that insurance creating the spaces where, so essentially sovereignty is shaped and structured by your insurability in that space, which is represented on your card, your colored card?
That's right. I was also thinking about activities that we might not perform if we do not have insurance cover. High-risk activities, for example. People doing certain forms of mountaineering, or even space, outer space trips and so on. The insurance of that is quite interesting, right? Would we do that or not? Going back in history as well, I came across this idea some years ago that what enabled the first ship of the Dutch East India Company, the VOC, to sail, because they wanted to get it to go a long time before, but they couldn't, was when it managed to get insurance cover, because nobody would send this there. But it was the only trip that was insured. Thereafter, the company self-insured. That changed things completely. Now, if you have a ship that is insured going to a world which is practically unknown, you are creating a space of risk, in this case, that is definitely exploring, worth exploring.
And also, you can also link it to the possibility to do commerce, to do trade. If you wanted to start a company in
Exactly.
Afghanistan, for example, you couldn't insure it as easily, so that would determine the geopolitics of the international trade.
It's the case of kidnap and ransom insurance. Remember that paper on kidnap and ransom insurance I once wrote? Yeah. It's about that too, that what is it that you are insuring as well, and you are kind of creating a business environment in order to operate in areas where it's very difficult to otherwise operate. So I think this basically presents us with a problem space, intellectually speaking, that we could go and explore. Let me put it here. We could go and explore, and it's definitely something that I haven't seen happening so far. And it brings together finance, but also political theory, geopolitics, international relations, you name it. Probably even physics. There's somebody from physics here. There might be some interesting elements to that there.
And science. Imagine you want to do your fieldwork project in Afghanistan, and you probably could not do that. So the shape of knowledge in your imagined global map would be different than than what it would be if you wanted to do it in Prague or something.
Or even take these particle accelerators that are so famous these days with all these wonderful experiments. Those are huge investments. I'm sure there's some form of insurance involved there too. Some management of risk. You want to ask something?
Yeah, it relates to the film that you mentioned, the Code 46, and also to the ship maybe. But you said that insurances create spaces, or sort of liberal spaces, actually, kind of work towards progress of liberalism, if I can rephrase it that way. Transcendence. But to me, it rather seems like the demise of liberalism, especially if you consider that movie, because that to me is a very dystopian, totalitarianistic system, and to me, at least, totalitarianistic and liberalism doesn't go together at all.
Absolutely. And here's where the really interesting rub, you're absolutely right on that, but there's a very interesting rub taking place all the time, that well, if you were to take Natalie, my fictional character, right, and take an absolutely accurate picture of who she is now, because you want to know what is it that you're insuring towards the future, and then you project that life of Natalie, right, as you have valued it, you project it into the future, and then you know what the price of the risk is, right? That's what insurers, that's the dream situation of insurers, having the right information that allows them to make that assessment. Okay, but what you are assessing there, even if you have the information to make the clear x-ray of the moment, is you are being able to assess capability, right? So you know that because she has done a PhD, and because she has got, she has published her books, and she has got tenure now, you expect that will continue growing that demonstrates a capability, and then you project that into the future. You also know that through her health history before the event that I mentioned took place, that she was relatively stable and that her health would continue normally for the rest of her life. That's capability. And that is the life that insurers focus on. But that is not our life. So when I am interviewing a colleague for a position at the university, I am always wondering, okay, this person demonstrates a particular capability of performing in the job, but what about the potential rather than the capability? Potential is that which you cannot anticipate, you cannot account for. Is that Natalie suddenly discovers something in the area of physics, although she did a PhD in political science, right? Or that she actually ends up writing the most beautiful poems ever, that actually allow us to access a dimension of life that nobody had ever been able to express, and so on. Or that Natalie is being able to, I don't know, invent something that nobody has thought of. That you cannot account for. That's the invaluable, that's the incalculable. And that is what defines life. I mean, how boring would it be if our life was completely predictable? I think we would have lots of people jumping out of the window, because then you just get bored of the routine, right? But what defines life is actually the accidents, the surprise. It's actually how Jean-Luc Nancy defines the event, as the surprise that the event that surprises order. And that is what allows us then to get very excited about things and passionate about ideas. And it gets us to move on to areas that we hadn't even thought about. So that's my question a while ago, that sometimes our biggest, deepest desires are not physically possible, or legal, or morally acceptable, or tolerable in any form or way. And yet they are desires, and they make us dream, and they make us imagine. But valuing life in terms of capability does not allow us to capture those kind of things. And I would say, thankfully, that is not capturable, because then that would be governable at the same time. And part of the idea is that our space of the imagination and so on cannot be governed, should not be governed. It's our own claim to freedom, and our own practice of freedom, I believe. But that's more or less what I was thinking about. You're absolutely right in your point, and there's a contradiction in terms there. In the logic, a flawed logic, I would say.
Well, is at the end, what's the path between today and Code 46? What has to happen? Maybe denationalization, Europeanization maybe, to get to the point where it's the insurance card which tells us where we can go.
I was wondering about that movie. Is it just that he wouldn't be insured if he goes there, or is it that he physically can't get there? So what I have been reading about this morning only was about a rating system that is actually put up in China. So at the moment there's private companies who do this rating, but I think starting from 2020 this will be enforced for all people in China, which is based on what you shop. If you pay your bills, anything. It's really what your friends do as well. So it's rating you as a person as a whole.
Yeah.
And even now, people are restricted in their travel. For example, they can't use a train if their credit level is lower than a certain threshold.
Right. Yeah.
So is it this kind of stuff? And because then, obviously, it would be extreme.
Yeah.
But it could also be that it's just the fear of this financial risk, which is posed by me going somewhere and the insurance not being valid. So it's a completely different point.
Is it physically too dangerous, or it's financially too dangerous?
Okay, the film actually introduces all kinds of things. It's definitely worth watching it now, because it is, you even get empathy viruses that are instilled on you, or some forms of prevention, a biological intervention in your body to prevent you from doing certain things. But you always want to do them. And you always have the possibility of, if you manage to circumvent the system, going and do the stuff. The guy ended up going to where he went, and he died eventually. And then the big question for the company is, what did we do wrong in order to prevent that? So a whole investigation gets into the game. Okay, but the role of fiction here is very interesting, because it dramatizes things to get us to think about them. It helps us reveal that which is unnoticed, that appears to be invisible. I don't think that we'll get to that point, because the kind of stuff that we do with this kind of research and so on to make these things visible, or at least I hope, is that we can render political that which has been presented to us as merely technical, right? When it's presented as technical, we say, well, we'll leave that to the experts. That's not something we have to deal with. When it becomes political, it's because we realize that the relations of power involved actually affect some of the principles that we consider dear. And we would expect, for instance, to have political debate around that through institutions such as parliaments, assemblies, this kind of things, right? So I don't think we'll ever get to that point of a utopia of governance through this particular way. There's always resistance. Wherever there's resistance, there's hope, of course, that things can be exposed and be made to work slightly different. There's all kinds of promising things happening, is that who on earth would have expected the European Court of Justice to stop the insurance industry from operating the way it did, which the insurance industry is usually very discreet, very quiet, very efficient in what it does. It puts a lot of effort on making that possible, of course, but suddenly you have this ruling that actually the insurers were caught by surprise when it came out. So we have a sovereign intervention in a practice which was normally left untouched. And if that happens, that's incredibly promising, because that means that there are mechanisms through which we can deal with that.
Political mechanisms.
Yeah, I guess, my question was more specific in the sense that if we're talking about insurances, then today at least we have always the option to say, I don't want to be insured, I just take the risk, I pay for it if I get into that situation. But if you think about certain risks, then a single person can actually pose a risk to a whole society. So what you could argue is that this person has to be restricted in what it can do.
Yeah.
Personally, because of the risk that it poses to other people, to the society, and then this insurance problem becomes a political issue. Because it puts that one person into context of its cohabitants.
That's the case of motor insurance, for example. So you, in order to be able to drive a vehicle, you need to have insurance over the vehicle. And it's actually one of the few which is legally compulsory, under the same reasoning that you were just presenting, that you become a risk for all the others. Never mind what happens to you if you don't want to cover yourself, but what if you crash against somebody else and affect the life or the property of others? So it has been made compulsory.
So do you think there's a trend towards this politicalization of insurance? So one example is maybe if you take terrorism, then you can now be made liable for things which you wouldn't have dreamed of before 2001, which is maybe carrying a bottle of water in your luggage, and then if you read the signs, it says you will be a criminal if you do this. Even though there's nothing dangerous in there at all. But you're a criminal just for posing the risk or this potential risk. It's absurd in that sense. Do you think there's a trend towards this?
There is. That's what I call technological reasoning. When those kind of things start happening and we don't say anything, we just go as humble subjects and just do it, right? It's actually controversial that many experts have said that has nothing to do with terrorism, and you're just creating a mechanism where you make people alert of the security circumstances and so on and so forth. But I don't think we're getting to a point where that is the trend and we're just following that line. I can tell you something. At the turn of the 20th century, 1899 to 1902, there were two very serious proposals on achieving world peace through insurance. And there was this, I think it was the president of one of the biggest life insurance companies, the Mutual, I think it was in the United States, who in an international conference came up with the solution to world peace, which is we get every single person on the planet to buy a life insurance policy. Because when you do that, and then you put some clauses, right, that in order to be able to hold that policy valid, you have to behave in certain ways. If you go shooting your enemy, then you're not covered, and therefore that has consequences. He says that's a way to achieve peace, right? Because we enforce a particular moral order in the world. Well, that was one, which sounds almost laughable to us these days, right? But that just illustrates the faith that some people started to put into the sector. The other one was that not people buying policies. That was not a good idea, they said. It's states who should be forced to have a peace policy, right? And it would be an expensive peace policy. But if they have that peace policy and they're attacked, you have all the money to repair whatever is damaged or and whatever, no? But if you are the attacker, then you're going to have to face some very serious consequences and so on. That one was taken a bit more seriously, but never really materialized. This is just to say that historically, we've gone through periods where there's a lot of, let's say, insurential hype and faith on what you can do through this kind of regimes. But we always realize, as you were mentioning, there's some values and some feelings and some fears and so on that escape this and actually drive us dearly. Nationalisms, for example, they're not logical necessarily. They might not make financial sense, and yet they drive people. No? So we always have this. This is just to say that I'm not pessimistic in the sense that we just follow that trend and we'll end up in the world of Code 46. There's always resistance to it. And then the point is to let these technologies of risk do what they can do really well, but not allow them to get into areas which they should not really get involved into. And the big fear now, I tell you that, is automated underwriting. So you don't get a person looking at your case. It's a machine that calculates through an algorithm, which Louisa Moore is going to tell you more about, I hope. And that algorithm becomes your judge, right? And determines if you're an insurable or uninsurable subject. And if you're an uninsurable subject, you might not have access to credit. You might not have access to certain licenses that you need to operate, and so on and so forth. That I would be more concerned about. And that's where we really need to bring the cases to scrutiny. But yeah, if you watch the film and you want to discuss it, drop me an email. That would be great fun, actually.
There's actually another that you remind me of with this Chinese rating system. It's from this series Dark Mirror on Netflix. And one of the episodes, it's exactly the way you describe, with this woman going through the world, and you rate everybody you meet. And if your rating goes down, then you can't get a mortgage for your house. And
Airbnb, if your rating is down, they won't let you a place.
But this is, I mean, if you buy a coffee at the cafe and you rate the waiter who smiled or gives you a hot cup, and your total rating.
That is total control. We don't need a government to do that. That's normally when we locate total control, we think of governments, right? But yeah, that is scary. Absolutely.
On that shining note, I think we can conclude for the day. Thank you very much.
Thank you for your questions. Very good.
Lobo-Guerrero.